We cannot have this conversation about real estate, about interest rates, without looking at our annual inflation rate, which is good news, dropped to 2.9 from 2.8, which beat the expectations of 3.1. And there was really a smaller increase in grocery prices and things like internet and cellular prices, and that offset a rise in gasoline prices, which, by the way, in the Fraser Valley are like $1.90 a liter these days. Anyways, prices were up only 2.4% year over year, which is really the least we've seen in the past couple of years. But most importantly was that the core measures of inflation came down. So the core prices dipped to 3.2%, and overall the changes in the 3-month moving average are now sitting just about above 2%, which is the good news from Tiff Macklem's point of view. So here's the other side of this equation that we've talked about many times. You know, interest rates are up, but it's also a part of the CPI basket. So in other words, shelter inflation is up 6.5% year over year. No surprise. And it continues to remain really sticky because it's driven by rents and mortgage costs. Again, I'm going to remind you is that inflation or interest rate, the interest proportion or the interest portion of your mortgage payment is in fact playing into the inflation, which is kind of awkward, isn't it? Because interest rates go up to bring inflation down, but they're part of the mortgage. So that continues to be one of those things.
What? Bro, what are you talking about, man?
But let's put it this way. Mortgage interest costs remain a really big driver of headline inflation. But if we take out those mortgage costs, our inflation actually drops to below 2%. Interesting. Now, this again maybe plays well into the Bank of Canada and saying we're going to slow rates or we're going to lower rates. I don't think we can expect that rate. I'll get to that in a minute, a rate decrease that is. But rent inflation is literally at 8.2% this year. Again, rents continue to rise. No surprise to you if you've been listening to this show and really paying attention. We've been saying it time and time again. As investors, we've got a lineup of clients and rents are in fact going up. So they will prove to be sticky given the immigration and the number of people moving into this country. Where does that put the Bank of Canada? You know, there's no question that bringing inflation down is good news. And actually, Bank of Canada said in March or at the March 6th rate announcement that it actually expected inflation to be close to 3%. When we strip out some things, it's closer to 2%. So some are hoping and actually calling for a rate decrease in June. I'm going to say it again for public record. I don't see a rate decrease, maybe even this year. And I know that's not probably what you want to hear, but I'm looking at a global macro and I'm going, I just don't see them reducing that rate. And the primary reason is that all of our asset classes are still on fire. So in other words, we're seeing gold and silver, Bitcoin as an example, the stock market, the S&P, the Dow Jones, they're all on a tear. And by the way, housing prices haven't really come off. So if they lower rates now, all they're going to do is take inflation to the moon. All to say this, I don't expect that we're going to see a rate decrease, definitely not in June, in my opinion. And I hope I'm wrong, by the way, but I just don't see it. And then on the other side of that, we have to look provincially at what's happening in inflation. And by this chart, the reason I put it up there is because Alberta has a very strong economy, as we all know, but with it comes the inflation. And so provincially, they're 4.2%, which is more than or at least double what's happening nationally. So the uptick in that inflation was primarily caused by natural gas prices. And then, of course, there's lots of controversy about the electrical prices. All to say this, Alberta still remains strong economically, although I think we're going to see some softening. Not to say that we should be worried about it. Pay attention to it. But the cost of living is, in fact, rising in Alberta. That may slow things down in terms of interprovincial migration.
Why are you shouting?
So these are all things that we're looking at when we're looking at the data to look and see what's happening in the future to make our decisions. So if you're in Alberta, you're feeling the pain of inflation a little bit more than outside. And then I'm going to add, just to finish this segment off, we have to get to one fundamental understanding. prices have really not come down, have they? You know, I know. We're paying more for gas, we're paying more for food, we're paying more for everything. And don't even get me started on taxflation and the increase in April 1st. Oh, yeah, that's going up again with carbon tax.
Disappointed!
The point is that when we look at what's happening economically and we look at inflation and CPI, always remember this. CPI is the rate of which prices are increasing. So in other words, prices continue to increase. We all know that. It is the rate of that inflation. So in other words, things are slowing down, not the amount of inflation, but how fast it's inflating. It's confusing, and the Bank of Canada has a play on words. I want you to look at the rate of inflation differently. And that is to say, inflation really isn't coming down. Prices aren't going down. The speed of which they're going up is what we're paying attention to. And that is what the Bank of Canada is making decisions on, is the rate of inflation. So hang on to that one, and you'll start to see into the future. Why does this matter? Because real estate will continue to inflate. That's why we invest in real estate. So we talk about GDP, we talk about inflation, and we would be remiss not to talk about what's going on. And for us as investors, we have to look at underlying what we have to be concerned about or need to continue paying attention to. So in this next slide, we start to see that businesses are, in fact, struggling. We're seeing more and more businesses get into trouble. A lot of that, by the way, is driven by these high interest rates. So in other words, the inability to finance inventory, to carry, to sell, the slowdown in retail sales, which is in fact happening, is all starting to slow down businesses. So we see businesses in terms of insolvencies have spiked. We also start to recognize that corporate bankruptcies are actually, in fact, happening. Now, what this matters to us is that as much as a lot of this, and I say a lot, we're starting to see a lot within the housing industry, this speaks to what I said before. We're going to see an uptick in unemployment. And we've got people moving in, not enough jobs to support. Then we got businesses that are either closing their doors or they're claiming insolvency, and they're slowing things right down or cutting right back. Now, this trend will actually continue. You can anticipate that. And we're going to, again, see that unemployment number pick up. That's not to say that we're going to see a huge slowdown overall, but underlying, and when you look at what areas, what regions you're looking at, these are the numbers that you need to be paying attention to and looking for. Your local news or your local data that you get is going to give you some insights into what's happening. So pay attention to those numbers. They translate to jobs. Jobs translate to strong economies. Strong economies translate to housing prices continuing to increase and people having money to spend. It's all part of the bigger picture. And so when we see insolvencies, when we see bankruptcies, we can know that the lag time into the future means that we're going to see a slowdown. And certainly that means jobs being lost. To expand on that a little bit, we're also looking at consumer insolvencies. Now you're going to read the headlines, and it's already, we're seeing it, not only consumer insolvencies, but we're talking about mortgage delinquency spiking up. But I want to just point something out here, is that you can see that insolvencies have spiked up, but they're still not over historic numbers. So in other words, the headlines will say one thing, but when we lift the hood a little bit, we go, yeah, we need to pay attention, but we've had stronger or more insolvencies over the history of the record here. We just go back to 2013. We're kind of on par with the trend over that many years. But the headlines will say it differently, and it could, in fact, shut people down. Like, it really will be a consumer confidence issue if they're starting to look at this data. So for you, just know that this is still within the trend. It's not outside of the norm, but that's not how it'll be presented. So to my point about mortgage delinquencies, again, you're seeing the headlines, and they're talking about, it's up 50% or it's up 100%. But when we look at the overall trend, this is not above norms that we've seen historically. So has it ticked up? Yes. Are delinquencies ticking up? They are. But that's not to say that they're above the trend line that we've seen over a number of years. I can't say it enough. We have to watch the headlines. We have to pay attention to it. And then we have to look into the future to say, okay, is this going to be problematic? There's a good chance that it is. But having said that, there's still mortgages out there that aren't going to be renewed for at least another year, sometimes 2 years. So as much as we're seeing some delinquencies uptick today, I don't know that it's going to be problematic yet. As investors, that creates opportunities. Remember that. That creates us, our ability, brings out our ability and creates the opportunity for us to solve other people's problems.
Teamwork make a dream work.
That's part of being an investor, solving those problems and being able to take advantage of what's happening economically from a perspective of being able to get deals done with people who need problems solved. They're in trouble for all the reasons they are. I'm saying again, it's not about taking advantage of anybody. It's about solving other people's problems. That's where opportunities exist. That's why you still need to be in this market. If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.